The more I analyze the market, the more signals I see that a serious downturn may be closer than many people expect. While most discussions right now focus on artificial intelligence or central bank decisions, something much quieter has been growing in the background: the private credit market. This is when companies increasingly borrow money not from banks, but from private funds. Over time, the connections between these funds and traditional banks have become very tight. In a stress scenario, that kind of structure can create a domino effect, similar to what we've seen in past financial crises. Let's start with the basics. What is private credit? It's when a company borrows money directly from a specialized fund instead of going to a bank. Imagine a company needs 200 million euros. Going through a bank can be slow and bureaucratic. A private credit fund, on the other hand, can move faster, but usually at a higher interest rate and under stricter conditions. Here's the key point. To lend that money, these funds often borrow capital themselves from banks, but at lower rates. As a result, this market has grown to nearly $2 trillion and is now one of the fastest-growing segments in global finance. The risk appears if companies start struggling to service their debt. In that case, pressure doesn't stay isolated. It spreads through funds and back into the banking system. This is why major international institutions have already flagged private credit as a potential source of systemic risk. It doesn't mean a crisis is guaranteed, but it does mean this area deserves much closer attention.